Howard Silverblatt is joining us this morning, a senior index analyst at S&P Dow Jones Indices. All right, Howard, so give us a setup here, because the big question now is, will eco-stabilization turn into real growth? What do we think going into earnings?
Looks like we're going to open up at another high today, passing that 3,300. This bull keeps going. It's 2 months short of 11 years. Obviously, low interest rates, good low unemployment is helping it. Earnings are coming through positively. Again, this seems to be the pattern for the last 4 quarters now. The estimates decline, then they beat them. But the bottom line is 26 out of the 32 that reported so far have beaten in 7 of the 10 financials. Obviously, you mentioned before, Morgan Stanley, going to be a strong opening there on that issue. And the volatility is somewhat low on here. We haven't had a 1% move since October. The VIX is relatively low. We just had yesterday signing of phase 1. You can debate whether that was a major move or not, but definitely signals a low attention in the situation. So the market, is looking positive, and inflows are up, which is typical of January.
So we've got the traders coming back into this market in full steam. We've seen ETF flows jump. We've seen the high beta stuff take charge. Howard, where is the earnings growth going to be, though? Are we going to see it in these big growth names and the expensive stuff, or are we going to see more of a cyclical strength as some of these engines restart of the economy? Are we there yet?
We're seeing broad gains. The quarter, at least for the fourth quarter, is not supposed to be spectacular. Original estimates were about 1% above last quarter. If you go back in time, it was supposed to be about a 10% gain, but again, they went down. We're looking for about a 3.5% gain on the numbers at this point in time. Financials definitely to improve on there, but the major difficulties is going to be in materials. Real estate, the earnings aren't looking at that great on that side either. But the fields we got to watch is one, the financials that we're at right now, and they're coming through mostly stronger. Again, Wells Fargo was a miss, but we did JP Morgan, Citi, both double-digit numbers, top and bottom. And the IT, obviously, is the major one. We're, again, looking at Microsoft, Apple, to see how they go on there. And, again, the numbers look like they're going to be decent. It's not going to be a stellar item. So you're keeping one eye on Q4 to say, yes, we did okay, but the major item is on the guidance going for 2020, because we need to justify those PEs. We're currently over a 20 PE on the actual estimates right at this point in time, and that's somewhat high historically. Yes, if you go out to 2020, for the full year 2021, they dropped down to the 18 and the 17 range, but we're currently at over 20 on there, and that's expensive. So we need to see growth in 2020 to justify the levels we're at now.
Howard, what would be an impressive beat rate for earnings? Because we always beat earnings. It's been that way for like I don't know how long, like what, 5 to 6 years?
Historically, about 2/3, 67% actually beat the estimates.
Okay.
A little bit less if you start playing in with the whisper number, which is not exactly quantifiable because it depends who you're talking to at that point. Right now, the early numbers are 81%, 26 out of the 32, which is unrealistic. It's 2 items. We'll probably get, again, over 70% because we've got a history of beating that recently a lot more, at least for the last year, than we historically do. But it's the amount that we beat the estimates by that we've got to look at. Again, the estimates have been reduced. If you look at the fourth quarter estimate a year ago, okay, it's been reduced 9.8%. So beating that reduced number is not too hard. Even 2020 has come down over the last year, about 5.9% it's been reduced. So again, as we get closer to reality, the numbers come more into what the expectations are, but they typically underestimate the estimate. So we're looking for beats.
Howard.
Okay, that's the rule. When you get a miss, it's a true miss, and you're going to feel it in the marketplace.
Yeah. What about buybacks? I know you track these religiously. Are we going to see big up in buybacks, or CEO's going to find something better to do?
The current item in buybacks is that they're still impacting EPS at this point in time. Okay, of the companies that we had that were able to deal, the 30 of the 32 were able to break it down, 10 of them, 1/3, had at least a 4% increase in EPS due to buybacks. So they're having an impact. The actual dollar amount, we're looking for a tick up, a little bit shy of the 190 billion, about 189.2 is what we're looking for. Now that is down from 2018 when we had 223. But 2018 was an overspending year. Companies just went overboard on buybacks. The whole year was $806 billion, a record. The second highest before that was 5,989, so there wasn't even a 600 number or 700 annual. Went right to 800. This year we're looking for that 806 to go down to 736 for 2019. So it is a almost 9% reduction in buybacks, but it's looked at as a win because, again, it was a big over expenditure last year. So looking for Q4 to continue on and to get another increase in 2020, this year, this fiscal year, to continue the market support as well as the EPS increases. Estimates are a little bit soft at that. I'm looking just about at a flat number, about 804, which would be shy of that 806, but there's a bunch of estimates going about at the 810 level, just beating that number. But somewhere around that 800 is the current consensus for 2020 buybacks.
Okay. Howard, one more before we let you go. Looking at your notes, the old, as January goes, so goes the year.
Yep.
What is that, just for stocks, or does that also mean, bonds, gold, this risk-off type of trade is going to happen too?
Definitely not. And there's a disconnect we've had for the last year, obviously, with bonds as well as gold. I mean, we saw the shoot up in gold to that over 1,600 level when we had the difficulty, and oil, which went to the 64 level, just broke back up to the 58 this morning. But no, this is just basically the equities that we're looking at. It holds somewhat true for the Dow as well, but the S&P 71.4% of the time as January goes, so goes the year. Yeah. And we're up 1.8% year to date.
Pretty good rate.
And so it looks like it's a positive start.
All right, 71%. Howard, appreciate it as always.